Welcome entrepreneurs to week 1 of FundReady program. I'm so excited that you are here. Oh, I've been waiting this for 2 years to actually do this. So I'm really excited. And we recently also partnered with SME South Africa, .co.za. So I am excited about that partnership to actually assist us to shortlist some of the funders that have a quicker turnaround time on short term. So on today, we're basically going to be covering debt, equity, and also the reasons why we get rejected, the 7 C's of credit. And I want to just go and expand on the 12 principles that I have found to be the reasons why some of the funding, including investments, end up not being financially viable, so that it prepares you to think about things as we are getting into this journey. Welcome. My name is Precious Mvulane. I'm going to be assisting you and helping you to actually get ready for funding for the next 12 weeks now. We had a launch last week and it was great. Entrepreneurs showed up. So I hope you are going to keep showing up, not just for yourself, but for everyone around you, so that the lessons that you are learning, you also are able to share with others. So the purpose for this is not so much as to repeat what is in the content, but maybe provide with some sort of explanation so that you can be able to understand and think about things to consider as you're beginning this journey. So I'm going to now share just to take you through the material so that you will see some of the content. You will already be familiar with it because you already are reading this. So I'm going to just share that with you. Okay. Yeah, I think that should do. Okay, I'm going to go from the beginning. Okay, so the first 8 pages of the training material is really providing you with what is the objectives and who's the target, plus also the time commitment. In addition to that, it's also just a toolkit that we're actually providing to you. We will add more toolkits as based on what you are actually finding it to be difficult as we are actually building up to this. We also have set up these to be very around the agenda. What's the agenda for this week? So the week program is from week 1 up to week 12. As I said earlier, we are now in week 1. I also just want to highlight in the training material, you have an appendix. An appendix has a ready program checklist. That checklist is basically guiding you to help you to tick as you complete each section. And then in that appendix, we also have the solutions or the answers to the pre-assessment. We also then decided on week 3 to have a detailed explanations on some of the answers, because sometimes it's difficult to just give yes or no or 1, 2, 3 or whatever case it may be with the multiple choice. Sometimes when some matters are more complex, it's better to provide the reasons why that is the right answer and the others are not applicable or not correct answers. So that is why we thought this will actually assist, especially for week 3. And again, on week 3, we have confirmed a facilitator, Dagmar from Funding Connections. She will be coming in, and for those who are gonna finish and submit their business plan will actually be eligible to submit their business plans for review to Dagmar. And that, I think, is amazing platform for us to get this business plan to be fundable. So let's go straight to our week 1. As I did explain earlier, that we're going to focus on debt, equity, grant, and other alternatives. So when we talk about other alternative, we're talking about venture capital, we're talking about crowdfunding, and also angel investors. So those are also considered as other alternatives. And then I just want to also say that as much as some of this information is generic information, I want to emphasize more on really on how we are approaching funding. And I think in the South African environment, sometimes we generally base it on whether it's grant or it is debt, or if it's not debt, then it will be equity. And we always put equity around the ownership, but sometimes it can be revenue based. Sometimes it could be just for that project, which can be a joint venture. So you need to understand that alternative are not recorded because we just lost electricity. God. Okay, I'm gonna assume that it did record. This is the fourth time, so I don't want to do it again. Okay. I'm gonna assume we still have some content, but and maybe if I've lost the introduction and I've lost the rest of the content, apologies. My name is Precious, and I'm trying to record this session, and this is the fourth time now. Then I lose electricity, and then I start afresh. Then the network is slow. Can someone, entrepreneurs in South Africa, can you come up with an innovative way for us to generate electricity? God, I feel like crying right now. This is just so exhausting. Anyway, we're in week one. If you have lost my introduction, I am so sorry. I'm going to just run through it. My name is Precious. We're here on week one on FundReady program, a program that is designed to actually help the entrepreneur to be fund ready, to be able to submit a tangible, a bankable business plan and a pitch deck, which they can actually give to funders, either investors, ventures, or angel investor, or even family members, peer-to-peer. It doesn't matter, JV, but it's about getting yourself the money that you need to grow your business. So that's what we're doing here. And thank you so much for making the time. We're in week one, and week one, but on week two of the program. We started last week going through the orientation, and thank you so much for making the time. And today we're covering debt and equity. We're also going to cover the alternative. We're also going to cover the 7 C's of credit. In week one, we're also going to focus on the reasons for rejection so that you understand what are the things that you're going to need to prepare for. And the last part, we're going to also look at the principles of actually getting funding. So yeah, and I'm going to share my slide, which is basically the training material that you have been given in no, stop sharing, it's the wrong thing. I'm sharing the wrong thing. Give me a second. Okay. Now I can't find. Okay, I'm gonna try in a different way. I think when I lost my information, I also lost the documents that I was working on. Okay. Give me a second, one more time. I had actually opened it. It was ready for sharing, but then it disappeared. Okay. I'm gonna share the Word document, and it's not hearing me. Give me a second again, entrepreneurs. Apologies for that. There we go. I wanted to show this as a preview. Share. Okay, so while I'm trying to get to the document, I think I have a big problem where I have too many documents that are open, and then I end up struggling to find my documents. I'm gonna just resume sharing, which is, there we go. I had opened it, I don't know. Oh, I think I'm getting old. Anyway, FundReady program, we're on week 1, and I wanna cover the principle of funding so that it allows us to for me to explain these principles. And I kind of felt like as much as I did explain it in the material, I need to emphasize them, but also provide examples so that you can understand why these are foundation principles. Principle number 1 is investment clarity. When you say, I am looking for funding, you are looking for money to finance something. That something is what we will call an investment. You need to have a very clear understanding what are you asking for in terms of what is the money gonna be used for. And that is what we call an investment. And be specific enough to state the purpose on which that investment is actually, the role it's going to play in your business, the impact it will have on your productivity and your profit, the type of investment it's going to be, plus also the duration of that investment. And I want to articulate this. Make sure that when you're asking for money and it's a long term or it's a short term, it matches with that investment. And also keep in mind that the investment comes first and then the debt. And I've explained this also when I was explaining management accounts on how financial statements work. Principle number 2, risk and return. Understand first what is the average return in your industry. Look at the listed companies in your industry and say, what is the average return? You can look at their dividends policy, that the last time their dividends were paid. You can also look at the interest rates that they are paying on the. That gives you some sort of an understanding that when you are now pitching a return to an investor, surely that return that you are pitching has to be higher than when you are going for a listed company. And that is because the risk of a startup or of a small business is higher. The higher the risk, the higher is the return. So make sure that your return that you are presenting to the investor is actually higher than your average in your industry. But that return of investment, it must have a balanced level of expectation. You must make sure that the trade-off of that justify the size of the investment also. So keep those 2-3 things together so that it makes sense to the investor to actually choose you over investing maybe in GSE and buying shares there. Why? Because the higher the return, the higher is the risk. And also the money with you is not as safe as when you are in the listed company because of processes and systems that they have in place. So just keep that in mind. Principle number 3 is really around financial sustainability of your business. I mean, as much as even if you are saying, no, Precious, I don't want them to fund my business. I want them to only fund a project. They will still look at the sustainability of your business. Was it profitable? Is there even a sustainable growth? Those questions are important because they then show some sort of a history, some sort of a past experience. And that is principle number 7. But it also shows that it is a viable business to actually do. And financial sustainability, it also tells you if you actually are going to reach the economies of scale. So just keep those things in mind. Leading that to principle number 4, which is scalability. Is your business scalable? And scalable is also linked to a principle of economies of scale, but it's also linked to say, is it an attractive industry? Is there a demand? Is the growth making sense in relation to what is happening in that industry as a whole? So what KPIs are you using to measure the scalability? If you maybe are saying, no, I want to reach new markets, you provide some data on how you have confirmed or verified or done some sort of a feasibility study to actually say, you know what, that is a potential. If you're expanding the operations, show how it will improve your turnaround time in your operational efficiency, show how the number of days of producing something or doing something will actually change. If it's an enhancement of a product offering, show how will that have more value either in brand value or in increasing the market share. And I know some of the things I'm mentioning, you might just say, but Precious, what market share? I don't even know what my market share is. And all I am saying, these are the things they're looking for. Find a way of providing some sort of a proof that there is a demand. That's why to some other entrepreneurs, I usually say, when you're going for a capital intensive proposal where majority of your fund is going to go to an asset, you're going to need to show that there is an appetite or there is what is it called? It's called, there's someone who actually wants to take the off-take agreements. There is leads that you have received which you could not attend. You can actually come up with a list of orders that you actually have received. So those are the things that you're gonna need to think about to decide to make sure that you can demonstrate that what you're doing is actually scalable. Principle number 5 is about communication and reporting. I will share a template with you on how directors need to actually report to the funders. I haven't included it on our toolkit because I've been panel beating. I was doing my own report recently to my funders. So yeah, they had questions, so I'm gonna panel beat it, and then it will be a better report. But that report also does not just come and just, it's a template. No, you work with the funder to design it, and then you present it. Then if they have questions, they then ask more questions, and then next time you know, okay, because this was my second one. So I realized that it is an ongoing process. But the most important thing about your reporting is just having a regular communication. And mine with my funders is quarterly basis. The next one is also really around being transparent, build trust and rapport, be open about the challenges the business is facing, but also indicate how you are dealing with those risks. And if you have made the mistakes, admit you have made the mistakes. And that is very important. So that is principle number 5. Principle number 6, you need to be flexible. The flexible is really around making sure that as much as you said, you know what, I'm going to the market to raise funds, I want a debt of 1 million. If the market says, no, we're only going to give you 500,000, be flexible to go back to the drawing board and say, okay, if they can't give me a 1 million, they're only giving me 500,000. What does that mean? Or maybe you went in and you said, I want a debt, and they can't give you the debt because they're saying maybe the risk is too high. They would rather offer you an equity. They wanna control the state. Be flexible. You rather own a 100. You rather own a 1% of a billion or a million than owning 100% of nothing. This principle is also linked to principle number 10. If then it's going to be equity, just understand it. They might actually be involved in ownership. They might also be involved in certain decisions in your business. They will also therefore have a right to appoint directors because they're now having a shareholding. So those are the things that you're gonna need to think about when, but all I'm saying, don't have a very strict or kind of a set mind of what you want. That is important, but if the market is responding differently, be flexible enough to figure out the way on how to work around it. I also think so this now talks to your funding strategy, which we're gonna work through together for you to design the funding strategy. But that funding strategy has not been tested. You have not gone to the market and now raised the capital. We might find that actually your product or your industry, based on your product lifestyle, your product life cycle, is not ready to go to the open market. We might also find that actually maybe the product ready, the management is not ready. We don't have enough skills. But again, if you don't have enough skill, you're gonna need to be open to say, okay, can I bring someone on board? And if I bring them, what does that mean? Market conditions might have changed when you did your business plan versus at the time when you're presenting. They might share a new thing, a new alternative to the product that you thought, you know what, I have figured this one out. So just be flexible. Have your ears and your eyes and your heart open. Focus on saying, will this grow my business or not? Look at the best interest of the business, not just at the interest of you as a shareholder. Principle number 7, past experience. Past performance. Past experience and past performance goes hand in hand. You see, when you are providing your financial statement, they will, in most cases, they will ask you for the past 3 years. There are instances where they will say, give us past 5 years, but mostly they will say past 3 years. The past 3 years, make sure that when you are presenting it, there is some consistency in it, but you are also transparent about your setbacks and your successes. It is very important to make sure that you can somehow present some sort of a track record on how you have performed and how you have overcome some of the challenges, or how some of the challenges that you face have actually somehow taken over certain things. or how you actually responded to it in terms of your strategies. So this is important because it then helps the funder to see how much you know your industry. They can also see, do we have a capable team or not? Because your past experience basically determine how you will actually be even in the future, is the foundation. But I want to also I wanted to, when you are presenting your financial statements or your past performance, be careful. Be careful. This happened to me. Be careful that there is some sort of consistency in your opening balance, post-balance sheet transactions. In my business, I had transactions that I did post-balance sheet. I only picked it up when they asked me, and some of the things didn't make sense because I had converted my loan account to be an equity. I have a shareholders loan account. So just make sure that when you have done your 3-year financials, you've put them together, get someone to review them one more time as a group. Because I think in my case, when we're submitting, we didn't realize that there was a latest version. So then they raise a question. You don't want the investors to be raising a question. And I'm usually very detailed, but I mean, I'm reporting to the CFO of a listed company, so she picked it up, so just be careful about that. Anyway, principle number 8, investors alignment. You have to be aligned with your investor in terms of core values. What is it that they are trying to achieve? What's the expectation? What are the different preference of that risk? But also what involvement do they want to have? I know on my case, my funders, they don't want to be involved. They just want to know, how am I doing? Is the money being used for the purpose it was designed for? But other investors might actually want to be involved. Literally, my meetings with my investors, I just literally 30 minutes, and it's never enough time to consolidate the whole quarter in 30 minutes on a business that has it's 4 divisions, so it then gets just complex. But what I'm saying is that stick with what they like than what you want to share with them. I think sometimes we will go with what we want to share with them than what they want. So just always be very precise. Start with what they want, and then if there's extra time, then put the stuff that you like. Principle number 9, design your exit strategy. When you are designing your funding strategy, don't do it separately, because the funding strategy define if you are looking for a 5 million, for example. Let's put that as an example. You're looking for 5 million. Between the 5 million, there might be stuff which has got movable asset, which we will use as asset funding, and then you might have portion of that 5 million where it is working capital. But within that working capital, because maybe you don't have debtors, which is your debt financing, or you don't have a purchase order, then it means you're going to go for a revolving loan or credit card or an overdraft. Do you understand what I mean? So it's going to depend on where you are in your business in terms of your financial statement status, but it's also going to depend on the nature of your funding. So when you don't have the exit strategy on your funders, it then also becomes difficult to know when is the money going to be due, and how can we make sure that there's a foresight, some sort of a cash flow projection on how you will start repaying that money. Because when you have a clear exit strategy, whether it's going to be acquisition or initial offering in terms of the public offering, or does it mean just paying back the money? You have to be very clear, because sometimes the paying back of the money comes with the interest, and sometimes it is a free loan account. So those are the things you're going to need to think about and plan them way ahead. It's not just about getting the money, but it's also about making sure that is very clear between your investors and even financiers, how they will actually exit. I spoke earlier about dilution of the management. If you're going to go with the equity funding, it definitely might lead to them nominating a director. And that director might be a strong person who come with a new skill. So it's really about also being open to understand the impact of equity funding and how will that affect the ownership, how will that affect the decision-making in terms of directors, because the role of shareholders is to appoint directors. Now, this also will talk to whether it's a minority shareholding, whether it's not. But in most instances, what we have noticed, they may not take a majority shareholding. They will take maybe between minority to a major shareholding, but they will still have a strong view. So you need to just balance that off. My role in the boardroom, that is, we're all jointly and several liable. Therefore, when decisions are being made, if it's a director's decision, we should make sure that all directors have both inputs are considered when decisions are made. And if then you also need to think about, if then there is disagreement within the board, or you can't make a decision and there is no one who has an absolute decision, those are the decisions that you can take them to the shareholders to make. Consider actually having that even on your MOI. And then principle number 11 is really about due diligence. How are you going to prepare for this due diligence? We are going to cover this on, I think it is 10 or 11, if I'm not mistaken. Yeah, it's probably 10 or 11, where we will prepare and talk through you on how and help you to actually prepare for due diligence. It's really about transparent. It's about providing an accurate information based on what you have. And when you don't have the information, qualify it and say, you know what, this is what I have, but I don't know for sure this is the best information, if you are not sure. Because when they verify the information and you are certain, you are sure, and then something else comes up, you will actually appear not credible, and they will not trust you. Trust and credibility is the currency in fundraising. You must have, when you're raising capital, the only thing that matters is the trust and credibility. Principle number 12, be teachable. Learn from the rejection, learn from the feedback. Don't be too, don't have high knee-jerk on them picking holes onto your documents. Actually, allow them, smile, keep on writing, making notes. Even if you do have an answer to their questions or their issues, while you have it in a certain way, just have it. Put it down, focus on just say, I want to receive as many criticism as possible, so that when I come back, I have fixed them or they're in my risk management document. Remember, it's about you learning from that feedback, you making sure you present the information in a way that it looks favorable to them. Consistently be adapting to new strategies. There's no point of staying with the same issue, the same document, that you have not addressed the matters that are in there. So, ladies and gentlemen, those are 12 principles that I wanted just to explain and work through because are important. I really want to think about them as you are approaching this process. And I also want you to be open to actually build yourself towards looking also at what are the possible things that will happen in your business, and if that happens, what will happen, and just prepare your mind and also your documentation around that. I also want to highlight that, you see, when you are at the startup, at the early start, or when you're at the growth stage, or when you are actually at a advanced stage of your business. It really also has to be linked to your product, the life cycle of your product. Just keep that in mind. So you can't provide me with a business that you are saying, Precious, I'm going for expansion and scaling, but when I look at your product life cycle, it's actually still at an infant stage. It has not matured, because that's an indication that when you go to the market, you're gonna fail because you have not done it before. So I really need you to make sure that your organization, your business is ready to scale if you are at a scaling stage, but if then that's the case, is the product ready also to go on the scale? Is it a scalable product? And is your processes, your systems ready for you to scale? The early stage businesses, generally, I will really want you to look at grant. I would want you to look at alternative funding like venture capital, crowdfunding, and those could be a great platforms for you to look into. But yeah, we will take you through that. Look at your business, will assess your own stage of business, and I've given you some pointers there on what will that mean, how will that actually work. So yeah. And I've emphasized that point I was raising about product. That is point number 6 in product development. Okay, I'm not going to cover the reasons for rejection because I think you're going to work through those. Those are not going to be a problem. These are known, 15 of them. These are known reasons for rejections. So please work through them. And then when you're done, and you work through them throughout the program, don't work through them once off. Work through them as you're going. So maybe use this as a checklist. 7 C's of credit, this is very important. I've explained those, and I've also provided you with the possible action list of the things you can do to actually improve that. I also have articulated the process for funding process, and there's few things that you're gonna need to do and work through. So yeah, we are actually gonna help you with all those processes and steps. Okay, so the best way of approaching this, as I said, use the checklist, go through the material, do your pre-assessment, listen to the video, then go through the detailed material, and then again do your quizzes and your pre-assessment. And then from that, and attend the session for questions, and then you are finished with the module. Then you move on to another session, and guys, you can go as fast as you want. You don't need to wait for everyone. If you are actually in a rush, just let us know so that we can review some of your things quicker if there's a need to review. Okay, we have included some resources, some support for you in this week for things for you to investigate and check. And we also are just providing you with this information so that you will know where to go. We are going to give you a link for some of the things where we have partnered with the funding or the funders, some of the funders. We will share that with you, which will help you to actually then shortlist. After this week, we'll give you that link for you to do, that will be next week. We'll give you the list for you to do the shortlist of who are you matching with, so that you will then have your top 5, a minimum of top 5 funders. And we, as I said, we have partnered with SMNE-South-Africa.co.za to also assist in that aspect. Thank you so much, entrepreneurs. I am so excited that you are here. I've taken longer than 20 minutes, but apologies. I just wanted to explain more, and also just to make sure that I share my personal experience also of what worked, what didn't work. And thank you so much for your time. See you soon. Yeah, goodbye.